I am Matthew Bishop. I'm New York Bureau Chief for The Economist magazine, and we're talking about financial innovation, data, and what's going on with two of the most interesting innovators in retail finance. Far side of the stage, Sebastian Siemiatkowski, who is one of the founders of Klarna, which is a Swedish credit payments site, which he'll explain a bit more about. And then to my immediate left, Errol Damelin, who's the founder of Wonga, which is a British site, which is a source of much controversy, which we'll come to in a moment. Now, financial innovation, I think, is one of the most interesting and difficult and controversial spaces where innovation is taking place. I've been writing about financial innovation for almost as long as I've been on The Economist. I remember writing at the end of the 90s about an article about whether companies like eLoan and LendingTree and so forth would, the first wave of 1.0 online finance would drive traditional banks out of business. We've seen very high-level financial innovation where the physicists have been recruited from the world of science onto Wall Street to come up with all sorts of derivatives, which some people say is what lay behind how we managed to get ourselves into the financial mess we're now in. We've seen financial innovation embraced as a poverty eradication tool. I've been involved very much in I was involved in the UN Year of Microcredit in 2005 as one of the advisors there, where the whole notion was that credit would provide a path out of extreme poverty for the very poor, and yet we now see, as that industry grows, that's become increasingly controversial, as SKS Microfinance in India went from being the hot stock in the year in 2010 into being something of a pariah as farmers with too much debt committed suicide. So it's an extraordinary, lively area, which raises all sorts of fundamental questions about what kind of society we want, how do we regulate innovation, how do we allow the right amount of innovation. And I just want to start, I guess, with the thought that Paul Volcker, who was the former chairman of the Federal Reserve Bank, said to me when I was researching a book on what happened in the financial crash, where he basically said the only useful innovation in finance, the only useful financial innovation in the last 30 years was the ATM machine, which is a fairly, in a way, fairly profound but fairly dismissive conclusion about what all this energy has actually produced. So I want to start with both. I'll start with you, Errol, and just ask you why you came to finance and saw that there was a potential for dramatic innovation, and just briefly what the key to your business model is.
Yeah, so I mean, what drew me to, and drew our interest in the space was very much the lack of consumer centricity in the whole space. So, banks had forgotten who their customers were. They had forgotten to even think about their customers. So had other kinds of informal lenders, and people were too obsessed with their own systems and processes and legacies, legacies of people and culture to think about the customer anymore. And so it's one of the last great consumer spaces that just hadn't engaged with technology and with data. And I think that's a fantastic opportunity to disrupt it and to create an alternative for consumers that's genuinely different.
So in a nutshell, what's the offering that you have at Wonga? What does the customer get that's different to anywhere else?
So what we understood was that when people have short-term cash flow problems, what they are looking for are solutions that are fast and convenient. And so, we provide small short-term cash advances on mobile devices on the web and guarantee money within 15 minutes, 24 hours a day, 7 days a week. And, we bring a huge amount of transparency to the process. We put the customer in control of it, so customers can go to wonga.com or onto our apps and select exactly how much they want for exactly how long. And so it's like configuring a Dell machine was, in the early days when Dell disrupted that space, by letting the customer construct their product that they want on the fly, around their own needs at that particular point in time. And then we fulfill and provide speed and convenience that was unimaginable with a traditional banking model. And so that, that's a crux of what Wonga does.
You go to your website and you literally have a little dial on there that says, how much money do you want to borrow and how many days do you want to pay it back in, and then it tells you you've got to pay like 10 million% a year or something for that amount of money. And it's very, very straightforward.
It is straightforward. And what's also innovative is that it's totally transparent. So it tells people exactly what it is. And so no one's ever misled. It's not that you get sucked into a process and get priced at the end or anything else. It's all out there and it's totally clear. And people choose, whether it makes sense to them or not. And it's very similar to getting into a black cab in London, in that sense, that you know what it's costing you and you can make a decision whether that makes sense to you or not at that particular point in time.
Now, Sebastian, briefly, what for you was the opportunity and what does Klarna do?
Sure, I think to us credit is something else. What credit really was about from the beginning is lubricating the economy, right? And I think that the problem with online payments for a long time has been, as soon as you want to buy something, you're asked to pay for it, and the payment is a pretty conversion-killing process. So basically, to be able to separate buying from paying and create basically something that is as the like button but a buy button, and then do paying later, is really the key if you want to create a true frictionless experience, buying experience. And hence the difference between the time in buying and paying is credit. So that's what Klarna is about. We've done that in Sweden now for 6 years, with about 20-25% of all e-commerce is paid through Klarna in Sweden, and now we're doing it in Germany and 5 other geographies. In Germany, we're, after a year, almost 2,000 merchants already connected. So it really feels that this is the true key to be able to increase sales online. So it's less about lending, as Wonga here, it's more about how can you use credit to reduce friction.
So just spell that out a bit more. Why is this a credit question, fundamentally?
In what sense do you mean?
I mean, when you're saying that you've used, I guess you look at Jack leaving Twitter, starting Square, that's one way of doing it. You put your credit card or your payments card through your phone. You've got PayPal online that isn't a credit-based system. How does credit make this easier?
Well, I think it's pretty straightforward. First of all, if you look at traditionally outside of US and UK, where debit cards are dominant, the fact that if you're paying with a debit card, you're actually shipping money first, and then hopefully you will receive a product from the merchant. While from the consumer perspective, being able to get a Rechnung or an invoice basically means get my product first, touch it, feel it, this is what I wanted, and then paying for it. So in the whole kind of consumer power thing, really credit is much more powerful, and it gives me the right to decide whether I want to pay for the product or not. So it is a huge difference in a sense. We joke a little bit about PayPal being the empty wallet, the kind of 1.0 wallet, and Klarna is the full wallet. So that's basically the difference. You can instantly use us, buy something, and then pay later.
Now, what is it, I'll ask you first, Errol, what is it that's changed that's made it possible to come up with this new way of deciding whether you're going to lend to someone or not? What is it about the evolution of data, the evolution of the marketplace that allows you to do this in a different way?
So it's about the cost and the availability of data and the cost of processing. So it's a technology and a data convergence, really. So it's about being able to understand people in much more detail through credit bureaus and other kinds of data that's more and more readily available, and then the computing cost of being able to crunch that data. So we go off and collect in milliseconds over 8,000 pieces of data on every application that comes into our system and crunch that through complex algorithms, and it's something that couldn't have been done at any cost-effective level 10 years ago. And so I think at the essence, those are the two big kind of trends that have come together at the same time.
And so you dramatically reduce the risk of you getting it wrong when you make a lending decision. Is that the basic point? Or?
Yeah, I think definitely so. I think, one thing is that usually a customer would go into a bank, you would fill out the customer, some kind of application, and then you would give that in. And actually, the data that you get there is very limited. It is what the consumer has given away. While when you're online, there are, as Errol was referring to as well, thousands of variables of your behavior. Not least, for Klarna, for example, we actually have SKU level data, which means we see not only the amount you're buying for, but actually the products you're buying. So we could see that there's a difference from both a credit and a fraud perspective, of course, if you're buying 3 iPhones or if you're buying, a pair of jeans. And also a lot of other things, length of email addresses. There are just tons and tons of behavioral data within that transaction that can be used to predict this, and actually helps consumers, because it means that it becomes better for us to be, or easier for us to predict who is eventually going to pay or not pay.
And one of the fallacies, Matthew, about, I think, in terms of our responses to the credit crunch, is this longing in many countries to the nostalgia of having a local bank manager or an equivalent who understood us and knew us, who we'd go and have a conversation with, which just makes the whole thing far more subjective. So I think in terms of kind of what was behind what Volker was telling you is this real suspicion about machines churning through objective data. But I mean, we've proven, at least in our model, beyond doubt, with over 3 million transactions, loans that we've made in the last few years, that objective data is dramatically more effective than subjective human-based decisioning around lending decisions.
I mean, what sort of percentage of losses do you have? I mean, in terms of, 'cause I mean, this is the great thing in banking, retail banking, is you think, well, I'm going to lend to 100 customers and I expect, say, 80% to pay the money back, and then the other 20% won't, and you kind of balance your portfolio and charge appropriately over that mix of repayment and losses. What kind of loss rate do you anticipate in your portfolio?
So there's just before we get to that, I mean, what you need to understand also is that almost all traditional credit organizations make money when people don't pay them back. So it's not as simple as that. They're trying to convert people to not paying them back most of the time. And that goes for traditional banks with overdraft late fees and NSF charges in the US, and credit card companies with people paying minimum charges. They make their money when people don't pay them back. So we designed a system where we make our money when people do pay us back. And so we're trying to optimize to a totally different solution. And so for us, it's our default numbers are lower than credit card numbers. They're single-digit numbers, and it's about how much risk you're willing to take on board in terms of making objective decisions at scale, and it's about optimization.
Sebastian, what about you? I mean, you presumably want 100%.
Right.
Accuracy,
there's once again a difference here, since we're basically catering to like the average consumer buying something online, and so it's very, I mean, everyone. I mean, if you look at the Swedish population, we have 6 million people in our databases out of a population of 9, so it's pretty much everyone. But I think that if you look at an acceptance level, almost like up to 80–90% are accepted, and it's less than a percentage that doesn't pay. So it's very, very limited. But that's also because basically this is less of a credit and more of a way of, once again, reducing friction, giving me an ability to pay after delivery. So I think that these are the drivers. It's a lot of what actually consumers you're catering to, basically.
And your challenge as a businessman is to make sure that you exclude anyone that's a bad credit, essentially, from your
That's
your
one,
database.
of course, and then fraud, which is, of course, a huge issue as well. Fraud issue, abuse, etc. So there's a number of these, yes.
I wanted to come to the issue of, what does predatory lending mean in this new world where you've got so much more accurate data about the person that you're lending to? Because, I mean, at Wonga, you've been the subject of quite a lot of criticism from the sort of moral financial majority, or whatever you'd want to call them, who say, you're charging absolutely preposterous rates of interest to people who, presumably don't know better. I mean, that's the underlying assumption of the criticism, is that these people are, rushing in, borrowing, and they're not going to be able to pay it back, or they're being ripped off. How do you actually think about, do you have a definition of predatory lending that tells you I wouldn't lend to that person because I don't think they're able to handle it, or what? How do you decide who to lend to and who not to lend to?
Yeah, so, I mean, look, the first thing is it's certainly not the moral majority. I mean, it's a small minority of people living in the past. And the reality is that amongst stakeholders through, the vast majority of stakeholders in the space, politicians and regulators, are massively, in favor of what we're doing at Wonga, and primarily because we take responsibility very seriously. So there is there is no doubt that there's historical context to be concerned around. And there's no doubt that there have been institutions and businesses for hundreds and hundreds of years who have taken advantage of people in the UK and in most other countries. So I'm very sensitive to the fact that there is a historical context here, and that we should all be concerned around consumer credit. But for us, the responsibility really has 3 legs, and the first is transparency. So as long as, in my view, you need to make people absolutely 100% aware of what they are paying and what they're going to get for it before they engage in the transaction in the most genuine terms possible. The second thing is to give people flexibility and control. So not to encourage people or force people to take any more credit than they need for any longer than they want it. So if that means that if somebody wants £111 for 9 days, they should be able to take that and not need to take £300 for 6 months or £3,000 for 12 months, because that's what suits the credit provider. So that's the second piece of it, is just provide people exactly what they need and want. And the third thing is to be really selective. So we accept around a third of applicants only. So we're using these technologies in this data to be very selective. And the reality is that there are people that where credit products aren't appropriate at a particular point in time. And so we're using thousands and thousands of pieces of data on the fly in real time to try and make the best assessment possible as to whether this is an appropriate product for the person. And so for us, it kind of comes down to those three tenets. And we're totally open and comfortable with people having a look at what we're doing. And people vote with their feet in this. I mean, we're a consumer-led business. We've got some of the highest net promoter scores ever recorded in financial services. Our net promoter scores are higher, in terms of customer satisfaction, higher than Apple's and Google's, never mind banks. So the reality is that people who use the service really like it, and they find it really valuable, and it de-stresses them in particularly stressful times. And we're very comfortable with that.
Sebastian.
Yeah, I think, once again, we're a little bit different in this case, but I think that if you look at it, so Klarna never lends out money. We only do in-store financing for physical products. And if you look historically, you could actually see that even in the US, as the credit crisis come about now, actually in-store financing hasn't have a huge increase in defaults, while credit cards have. So I think as soon as you lend out cash, you're kind of in a different space. But what we do is really, we look at, just as Errol was in as well, I mean, we want to make sure we don't make money if somebody doesn't pay. So we want to, of course, make sure that the person who takes a credit has the ability to pay for it. So I think that that's basically the #1 driver. But once again, it's much less of credit used for lending in our case, and more of a way to increase sales for the merchants.
So as you both look at this landscape of finance, I mean, how much scope for innovation do you think there is? I mean, because you talk to the mainstream banks and they say, well, actually we're now pretty good at spotting when there's someone using someone else's card inappropriately, or we're now much better at figuring out whether someone's a good risk or not. And so there isn't a lot of scope for dramatic disruptive innovation, and yet you two in different ways have found niches. Are those the last kind of couple of niches that are there, or is there going to be a lot more transformation of this industry? Maybe we start with you, Sebastian.
Sure. I think the banks are really, sorry to say so, but far behind when it comes to these things. And I just recently spoke to a risk officer of one of the largest banks in Sweden, and they just were super happy because this was the first time they've been able to marry all the data of the consumer in one spot, and that was a couple of years ago. So there's a huge opportunity here where we actually do use the data we have internally mostly, and are not dependent on external credit bureaus, etc., etc. But just driven that forwardly. I know that the iterations, when we come up with a new idea for a new model, we can implement it within days, while in a typical bank it could take years. So I think that just in that small piece, there's a huge opportunity. But in general, I mean, the banks are building, the problem for the banks here is that they have systems built in the 60s, 70s, mostly in COBOL, and to be able to change this and actually develop it into something new is a huge challenge. So I think that the banks are,
So you think it is actually systems rather than, so it's legacy systems as much, I think, because some of the banks that I talk to would say, it's not that, it's about regulation. The nature of regulation of consumer financial services in particular, is so risk averse and so cautious that, we would love to innovate in all sorts of ways, but we can't. And you take something like PayPal. I mean, the reason PayPal managed to get started was somehow the people in government were too dumb to realize what they were doing.
Right.
And it became established and popular, and then they couldn't regulate it out of existence as they might have done.
Well, I think the problem with all big companies is if you're an employee and you take risk, if you do well, then maybe you get rewarded. If you don't, you get fired. So you always kind of have the challenge. And an entrepreneurial-driven company has another opportunity in that sense. So I think but at the same time, we're regulated as a bank. We have deposits that are governmentally insured. We need to follow the same regulations as the bank. But it's more about looking at, okay, what are the legislators really want? For us, for example, if we come to credit fees, we're not more expensive than the credit cards anyone else. So we try to keep within that, because we think that then the regulator will allow us to experiment and come up with better ways of doing this. But we work very closely to the regulators as well on these issues.
Errol?
Yes, I think the banking model generally is a dinosaur model. Most banks are being kept alive on artificial life support, and we're all providing that support through taxation. So, there's artificial barriers to entry. They've co-opted regulation to help them create barriers that make it very difficult for other businesses to enter that space. But I think when you just take a step back and look at the person using the service, certainly from a retail banking perspective, I think in 15 years' time, most people coming out of school and university won't be assuming that they have to use a bank. And I think that will be a fundamental shift. And when that happens, it encourages all kinds of businesses like Klarna, like Wonga, and hundreds of others, hopefully, to start providing services that people really want. And this perception that one needs a bank will be seen for what it is, which is to be baseless. And I think people will look for providers that really focus on their needs and focus on solutions for them. And I think the web pointed everyone in that direction. The winners, the Amazons of this world and the Googles, think about the customer and then build systems around that. And and the best companies constantly put the customer at the center of what they're working on. I think that's where this goes. It will take a while because there is this artificial life support that most industries don't have. But it will happen. It's unsustainable that banks carry on doing what they're doing.
So I'm interested to get both of your reactions to what lessons you feel we should learn from the subprime mortgage crisis and how that fed into our financial meltdown. Because, some people have taken, and I think I share an element of that. They've said, well, what happened basically was you had an extremely highly motivated finance industry focused on selling product, dealing with an extremely stupid customer base that was willing to take what looked like free money and then found that it couldn't handle it. And so there's one of the solutions or ideas that people have said should catch on from that experience is that we go back to the kind of It's a Wonderful Life notion of the bank at the heart of the community, us pooling our savings, sharing with our neighbors, making sure that we never charge preposterous rates of interest and so forth, and get back to traditional real banking. And what you're talking about seems to be, if anything, you're really saying the customer is capable of paying 1,000% interest rate and that not being a stupid decision. Whereas most people would say, well, anyone that's willing to pay 1,000% interest rate, the de facto, they're probably pretty daft in that situation and probably should be not allowed to do that. And that's where the regulators come in. So, what do you think? Do you think the customer is bright enough to handle your innovations?
I think it's so condescending of you. It's quite typical of a lot of responses to it. People are very smart when you provide.
I was being the devil's condescending advocate at that point, but please.
I think people understand cash and the cost of money. I think what banks did is they consciously made it difficult to understand. They consciously created product where there was a lack of integrity and a lack of transparency built into it. What we found over millions and millions of transactions is that when you let people price things in cash and they know what they're paying for something and what they're getting, they're absolutely making smart decisions. In the case of Wonga, we're far cheaper than any UK bank if you're going to go over your overdraft limit. So we're much cheaper than going over your overdraft limit with Lloyds, and it's a very smart decision to use Wonga. It's a much safer solution than going over your overdraft limit and much less expensive. And people make that decision in a very smart and considered way. And so I think one needs to make it transparent and then let people make the decisions that that suit their particular point in life. And I think trying to regulate from the centre isn't the way to do it.
So you see the financial crisis and that sense that a lot of people took on loans they shouldn't have done as more the product of just a lack of transparency in the system, or?
Yeah, I don't think people behaved irrationally given what was on offer. I mean, I think the problem with it was a lack of transparency in terms of what was offered.
Yeah, I think as well.
And that's where the regulation should go.
If you look at the subprime, it's really interesting. In the end, they were, what was that? No interest, no income type of lending, where I mean, basically anybody who would be looking at that realizes that if you lend to anybody who walks into the street, say, I want some money, and you don't do any background checks, yes, there's going to be a crisis eventually. And I think that the very difference of both what we are doing is actually the fact that we're very data-driven. We're really looking into a number of different ways to be able to predict those and actually say yes to the right person and say no to the right person. So I think that's a huge difference.
We're almost out of time. I just want to ask each of you to finish up by giving us your vision of where your company is going to be in 5 years from here. You know, what's going to be different from where we are today, Sebastian?
Yeah, I think I already said that in some ways, since we're kind of the new wallet in our case. We think that the online payments is going to really be like the buy button eventually. We think that it's just going to be a click, and it's going to be based on credit because it's the most frictionless experience you can get. So for Klarna, it's really about hopefully becoming one of the dominant payments companies online and beat that other wallet company. I'm not going to say their name right now. So that's really what we want to do.
And you think there's actually a future for a company that to be actually visible as a standalone company rather than just something you have built into your mobile device that you don't even need to know about?
Most definitely. I mean, just look at the amounts of data that we're collecting. We're actually seeing not only where the consumer buys, but we actually see what they buy on a product level. That data, I mean, look at Mint.com in the US was trying to do some stuff on that, but you can do even more if you have SKU level data. You can really help the consumer show their whole buying patterns and everything. There's tons of stuff to be done there that I think is going to be very, very appreciated by consumers to help them in their everyday life.
Errol?
Yes, I mean, we think that people have short-term cash flow challenges in many countries in the world and in many contexts. And I think what we'll be doing is getting into those multiple contexts and into multiple geographies and becoming a very present alternative for customers so that, at least in one part of their financial lives, they're not reliant on the default, which is the bank.
But you're not seeing a lot of new product innovation?
Yeah, no, I think there will be a lot around the context. So, at the moment, people come to Wonga either we pay bills for people or they borrow cash from us. But the other contexts in which people require financing, and so we'll be helping people in more than those contexts and in multiple geographies.
Well, Sebastian, Errol, we're out of time, but thank you for a really stimulating conversation. Thank you.
Thanks.